Welcome to our deep dive into hedge fund performance. Hedge funds are investment vehicles that pool capital from accredited investors and employ a variety of strategies to generate returns. Unlike traditional mutual funds, hedge funds often use leverage, derivatives, and short selling to maximize gains and minimize risks. In this video, we'll explore how hedge funds perform, what factors influence their returns, and why their performance is closely watched by both institutional and individual investors. Let's start by understanding what makes hedge funds unique and how their performance is measured in the financial world. To evaluate hedge fund performance, investors rely on several key metrics. These include absolute returns, risk-adjusted returns, and benchmarks like the HFRI index. Absolute returns measure the total profit or loss, while risk-adjusted returns account for volatility and risk taken. Benchmarks help compare hedge funds to broader market indices. Understanding these metrics is essential for assessing whether a hedge fund is truly outperforming or simply taking on more risk. We'll break down each metric and explain how they are used in practice. Hedge funds have a long history of delivering both impressive gains and disappointing losses. Over the past decades, their performance has varied widely depending on market conditions and strategy. During bull markets, some hedge funds outperform by leveraging market trends, while in bear markets, others protect capital through short selling and hedging. We'll look at historical data to see how hedge funds have fared in different economic cycles and what lessons investors can learn from these trends. Hedge funds employ a variety of strategies to achieve their performance goals. Some focus on equity long-short, betting on both rising and falling stocks. Others use global macro strategies, making big bets on currencies, commodities, and interest rates. Event-driven funds capitalize on corporate actions like mergers and acquisitions. Each strategy comes with its own risk and reward profile, influencing overall performance. Understanding these strategies helps investors anticipate how a hedge fund might perform in different market environments. Risk management is a cornerstone of hedge fund operations. Funds use sophisticated techniques to limit losses and protect gains, including diversification, hedging, and stop-loss orders. By spreading investments across asset classes and geographies, hedge funds reduce exposure to any single risk. Hedging strategies such as options and futures help offset potential losses. Effective risk management is crucial for consistent performance and investor confidence. Leverage is a powerful tool used by many hedge funds to amplify returns. By borrowing capital, funds can increase their exposure to investment opportunities. However, leverage also magnifies losses, making risk management even more important. The use of leverage varies by strategy and fund, and it's a key factor in performance outcomes. We'll discuss how leverage works, its benefits, and its potential pitfalls in hedge fund investing. Hedge funds typically charge high fees, including management fees and performance fees. The classic 2 and 20 model means 2% of assets under management and 20% of profits. These fees can significantly impact net returns for investors. While high fees are justified by the promise of superior performance, not all funds deliver. We'll explore how fees affect performance and what investors should consider when evaluating hedge fund costs. Pairing hedge fund performance to benchmarks is essential for understanding true value. Common benchmarks include the S&P 500 and HFRI index. Some hedge funds consistently outperform while others lag behind. Benchmarking helps investors identify funds that add real value versus those that simply follow market trends. We'll look at examples of funds that have beaten benchmarks and discuss the importance of relative performance. Alpha and beta are core concepts in hedge fund performance. Alpha measures a fund's ability to generate excess returns beyond the market, while beta represents market risk exposure. A high alpha indicates skillful management, while beta shows how much a fund's returns move with the market. Understanding these concepts helps investors distinguish between skill and luck in hedge fund results. In recent years, hedge fund performance has been mixed. Some funds have delivered strong returns during volatile markets while others have struggled. Factors like global economic uncertainty, interest rate changes, and geopolitical events have influenced outcomes. We'll highlight notable funds and their performance, providing insights into what's driving results today. Market conditions play a significant role in hedge fund performance. Bull markets often favor aggressive strategies while bear markets reward defensive approaches. Economic cycles, inflation, and interest rates all affect returns. Hedge funds must adapt quickly to changing conditions to maintain performance. We'll discuss how funds respond to market shifts and what investors should watch for. Investors expect hedge funds to deliver superior returns and manage risk effectively. However, expectations must be realistic as not all funds outperform. Transparency, communication, and performance reporting are key to managing investor expectations. We'll explore how hedge funds build trust and what investors should look for when choosing a fund. For investing in a hedge fund, due diligence is critical. Investors analyze fund strategies, performance history, risk management, and fee structures. This process helps identify funds with strong potential and avoid pitfalls. We'll outline the steps of due diligence and provide tips for making informed investment decisions. Transparency is increasingly important in hedge fund performance. Investors demand regular reporting, clear communication, and access to fund data. Transparent funds build trust and attract more capital. We'll discuss best practices in reporting and how transparency impacts performance and investor satisfaction. Regulation affects hedge fund performance by imposing rules on transparency, risk management, and investor protection. Regulatory changes can impact strategies and returns. Funds must comply with laws to operate successfully. We'll examine how regulation shapes the hedge fund industry and what investors need to know. Technology is transforming hedge fund performance. Advanced analytics, artificial intelligence, and algorithmic trading are changing how funds operate. Technology enables faster decision-making and better risk management. We'll explore how hedge funds use technology to gain an edge and improve performance. Hedge funds operate globally with major centers in the US, Europe, and Asia. Performance varies by region due to market conditions and regulations. Global diversification can enhance returns and reduce risk. We'll look at the global hedge fund landscape and how regional differences impact performance. Hedge funds primarily serve institutional investors, but retail participation is growing. Institutional investors demand rigorous performance and risk management. Retail investors face higher barriers but seek diversification and returns. We'll compare the needs and expectations of both groups and how funds cater to them. Liquidity is a key factor in hedge fund performance. Some funds offer daily liquidity while others lock up capital for months or years. Liquidity affects risk, returns, and investor flexibility. We'll discuss how liquidity is managed and its impact on performance and investor satisfaction. Hedge funds are often tested during financial crises. Some funds excel by protecting capital and exploiting market dislocations while others suffer losses. Crisis performance reveals the strength of strategies and risk management. We'll analyze how hedge funds performed during recent crises and what investors can learn. Emerging markets offer unique opportunities for hedge funds. Higher growth rates and less efficient markets can lead to outsized returns. However, risks are also greater, including political instability and currency volatility. We'll explore how hedge funds approach emerging markets and the impact on performance. ESG factors are increasingly important in hedge fund performance. Funds integrate environmental, social, and governance criteria to attract investors and manage risks. ESG investing can enhance returns and reputation. We'll discuss how hedge funds incorporate ESG and its impact on performance. Performance attribution analyzes the sources of hedge fund returns. It breaks down gains into market exposure, strategy, and manager skill. Attribution helps investors understand what drives performance and identify strengths and weaknesses. We'll explain how performance attribution works and its value for investors. Selecting the right hedge fund manager is crucial for performance. Investors evaluate track records, investment philosophy, and risk management. A skilled manager can deliver consistent returns and navigate market challenges. We'll outline the criteria for manager selection and its impact on performance. Fund size can influence hedge fund performance. Large funds may have access to more resources but face challenges in nimbleness and returns. Smaller funds can be more agile but may lack scale. We'll discuss how fund size affects performance and what investors should consider. Performance persistence refers to a hedge fund's ability to deliver consistent returns over time. Some funds maintain strong performance while others fluctuate. Persistence is a key factor for long-term investors. We'll examine the evidence for performance persistence and its implications. Investing in hedge funds comes with pitfalls, including high fees, lack of transparency, and performance variability. Investors must be aware of these risks and conduct thorough research. We'll highlight common mistakes and how to avoid them for better investment outcomes. The future of hedge fund performance is shaped by innovation, regulation, and market dynamics. Funds that adapt to new technologies and changing investor demands are likely to succeed. We'll discuss trends and predictions for hedge fund performance in the coming years. We've covered the essentials of hedge fund performance, from metrics and strategies to risks and opportunities. Understanding these factors helps investors make informed decisions and maximize returns. As the hedge fund industry evolves, staying informed is crucial for success. In conclusion, hedge fund performance is influenced by a complex mix of strategies, market conditions, and management skill. Investors must evaluate funds carefully, considering fees, transparency, and risk management. By understanding the drivers of performance, investors can better navigate the hedge fund landscape and achieve their financial goals.